Good afternoon, everyone. It is Thursday after the close. I was going to run through a few charts before I head home and thought I would just pull up the recorder and share those with you. So let's jump into a couple of things to share where market and position is at for us. As you recall, we maintain our underweight position. We're just a little bit cautious about the next, let's call it 30 to 60 days at least. This chart that I have on the screen is of the 10-year U.S. 10-year Treasury yield. So you can see in the last couple of videos I've done, I've had that purple little channel there across the top that ranges anywhere from, let's call it 4% to 4.3%. We've been spending a lot of time in there. We broke above that here late last week, and rates have continued to go higher. We reached a high up here of 4.68%. I've felt that this could extend all the way to 5, and at this point it doesn't seem completely off the table. Definitely in an uptrend. The last 2 days have kind of paused a little bit, but the uptrend is still very much intact. The 50-day moving average continues to climb. This is a pretty substantial breakout. It'd be hard to say that it's a head fake at this point. We've also reached oversold or overbought on a momentum basis, which would indicate a possible short-term pullback, but that momentum is strong enough that it could continue to climb. So interest rates still climbing. This is affecting mortgages, car loans, credit cards, flexible credit like home equity lines of credit, things like that. Interest rates going higher is just going to continue to tighten the economy and make it hard to borrow and afford what you want to purchase, which slows down the economy. But B, makes it very difficult to be willing to invest for the long term. I think that's the stagnation part of where we're at, is people are not looking long term because of this fear of the unknown of where rates can head. The next, let's take a look at the dollar. We spent a lot of time talking about that over the last couple of years. After falling down here to 100 in July, you can see a pretty steady increase here through the last couple of days. Today was down. Again, was that a head fake? Is it just taking a cooling off? The momentum and the trend is definitely for a higher dollar. So if interest rates are going higher and the dollar is going higher, it's going to be very, very tough for stocks to go higher. More specifically, international stocks are going to struggle as the dollar continues to climb. So we maintain our underweight positioning on international and emerging stocks as well. So dollar and interest rates going higher, very tough for stocks in general, even more so with the high beta, high growth area of the stock market. It's going to struggle even more. Lastly, let's take a look at the S&P 500's overall stock market. Today, decent pop. This candle can, some people call it a hammer. I call it a shooting star. It kind of goes down and then it pops back up. We did see some follow through on that today. So when you have a candle like this and then you have one engulfing it, it's very short term in nature. Looking at dailies is tough. But even more so, just one day of follow through after a big dip and then a rally, one day of follow through is kind of hard to rely on. If we can get a second or third day of follow through would be positive. But if we flip these to look at weeklies, right, which longer term look typically gives you a better indication of trend. On a weekly basis, we're still not going anywhere. We're still in a small little downtrend here. A lot of our research partners are targeting this, low 40, high 4100s to 4200 area as a potential spot for the market to kind of turn around or consider going back to neutral. So that's what we've got our eyes on. Coming back here into this range where that red line is would be kind of a target to want to go from underweight, which we are, back to neutral. Falls even further from that, we'd move from neutral to overweight. So just struggling. Again, we've been on a pretty good rally since October of last year, so this is somewhat to be expected. The part that kind of has my ears perked up a little bit is that we experienced a lower high. Okay. In uptrends, you want to see, it's okay for the market to pull back, but when it rallies back up, you want that rally to go higher than the one before that. So in this example, we would have wanted Where did my line here go? Sorry about that. I moved the red line. We would want this rally here, the second purple circle, we would have wanted that to extend beyond that top red line. Okay, that means we're getting a higher high and that the trend is still intact. So not only did we get a lower high, but we are also, if I can jump back to my marker here, we're getting a lower low. Okay, so that's the double whammy, lower highs and lower lows. That would indicate more of a pullback is coming. So what's the target? Well, here's our ultimate low from back in October. Here's a higher low, here's a higher low, right? So I don't know where it's going to be, but somewhere out here, we would want to see a pretty strong stopping, right, and a reversal to say, okay, the shorter term trend, this stuff over here on the right, lower highs, lower lows, but the longer term trend, we're continuing to see those higher highs, which would indicate that there's a bigger chance that October was the definite low and that we are in this new fresh bull market. So still a lot to be seen here over the last couple of weeks, but we're getting more ready to get back to neutral as the market continues to fall back. So again, appreciate all your time. Hope you all have a great Friday and an awesome weekend. We will talk to you all very soon.